Now, some of the banking regulations certainly outlive themselves and they no longer serve a purpose. However, bank regulations are meant to protect consumers and protect the system. These regulations were implemented to prevent banks from being able to take on the same type of risk that led to the swift collapse in 2008 in the first place. The goal is very simple: make sure that banks didn't become over-leveraged again. In addition to capital requirements, U.S. banks have been restricted as to how many U.S. treasuries they can purchase. Even though U.S. treasuries are backed by the U.S. government, meaning that they are effectively risk-free, in practice, they are not risk-free, even though as long as you hold them to their maturity, you will receive your principal back, and of course you will receive the interest. But that is only if banks do hold these treasuries until they mature. In unforeseen circumstances, think the worst-case scenario, such as, for example, a bank run. Banks would have to sell these treasuries to raise cash, to raise capital, to pay out deposits. And that might seem like an easy and relatively straightforward thing to do, but it's actually not. It might cause a bank collapse if a bank bought these treasuries when interest rates were low and rates have increased since that point in time, which of course is the case in our modern environment, and it has been for several years. Banks are sitting on billions of dollars in unrealized losses, and it means that they may not even be able to produce enough cash to pay out all deposits in that worst case scenario.